Now we're going to look at the elements of credit risk and explain how credit risk is measured for a portfolio of fixed income products. So the elements are credit spreads, ratings, and then finally value at risk is a concept that we'll be dealing with in much more detail in later topics. So I'll only very briefly mention it here. So, as I said in topic 1, credit risk is the uncertainty. Risk is uncertainty. So it's uncertainty in the value of an investment, that's financial risk, due to a credit event. And credit risk always concerns the investment in a financial product based on a bilateral agreement between two counterparties. Even if it's exchange traded, like a bond can be, there's still the company that issued the bond and you yourself that's purchased the bond. So there's always two counterparties. And very often in the OTC agreements, like interest rate swaps, the two counterparties have lawyers that get together and use the ISDA swaps documentation to make the agreement. So a credit event can be one of two things. It's either a change in the credit rating of a counterparty, which results in a change in the credit spread. And I'll explain what I mean by that in more detail. Or a credit event could be the counterparty actually defaulting on their obligation to pay whatever it is, interest on a loan, for example, or coupons on a bond. So because there are two types of credit event, there are two types of credit risk. There's credit spread risk, also called credit migration risk, and credit default risk. So let's remind ourselves about these credit ratings. The main credit rating agencies are Moody's, S&P, and Fitch, and they assign an issuer of a fixed income product a rating or grade that indicates the possibility of default. For example, S&P and Fitch, they have ratings ranging from AAA, AA, A, BBB, etc., down to C and also D for default, and you can also add pluses and minuses to those. Moody's uses a slightly different system. The first letter is capital, and the second letter is either two A's, two little a's, one little a, or nothing. So it would be, for example, B little a, B little a, and B, instead of BBB, BB, B. And the minimum rating for an investment grade bond is BBB. Investment grade is important because things like pension funds are not allowed to buy bonds that are not investment grade. Ratings of less than BBB are actually called junk bonds. They may not be that junk, but they're called junk bonds, or in more politically correct language, high yield securities. And rating agencies periodically assess the rating, the credit score of a company. They can use Z scores or any number of ways to reach their credit rating. These models can be very advanced. I'm not going to go into how they do that. But if it places a company on a watch list, it means it might downgrade because it views that the company is going to find it harder to meet its obligations. Credit spread risk is the risk of loss resulting from changes in credit spreads. And credit spreads are a premium above the risk-free rate. And that's the extra interest that the market requires for taking on a credit exposure when calculating the net present value of the future cash flows. So both risk-free rates and credit spreads have curves. In other words, they depend on maturity. There are different yield curves for different credit ratings. Risk-free rates are yields derived from government bonds, so they always depend on the country. Credit spreads also depend on the country, and the credit rating of the counterparty. For example, if a 3-year AA bond is issued by a US company, the relevant reference rate could be the yield on a 3-year Treasury bond, and the spread would be the US 3-year AA spread. So the term structure of credit spreads often, but not always, is upward sloping. So here you see the Treasury, or the risk-free yield curve in blue, and the yield curve for a corporate bond at several basis points above the risk-free curve. And the credit spread at shorter maturities typically would be smaller than the credit spread at longer maturities. This curve illustrates the spread above the risk-free yield curve. That's the grey one, the government yield curve. Then you've got a corporate, the investment grade AA yield curve, and then you've got a double C, the navy blue one here. The darker blue is for the high yield or junk bond yield curve. Why do credit spreads change over time? Well, they depend on the economic health of the company. General Motors used to be a top-rated company. Its 5-year bonds used to trade at a spread of 3% above the 5-year Treasury bond. But now, General Motors bonds are only just classified as BBB, in other words, investment grade. There's an article on that link. You can look at it yourself. Fitch's credit ratings of GM were downgraded in that article. Also, credit spreads widen when the economic health of the country deteriorates. For example, you can see on this link, although maybe easier if you click it yourself because the color is not very easy to see, but here you can see the last 50 years of spreads between a BBB corporate, BAA and Moody's speak, and US Treasury bonds. So you can see at times, for example, 2008 after the banking crisis, or 2020 after COVID, or the 1980s during the Gulf War, that all these spreads were peaking at that time. And that spreads here, you can't, it's very small, but this is 6%, whereas this is 4%. Spreads are bigger on the BBB compared with the AAA bond. So they have all sorts of spreads here. And a lot of information, so I thought I'd take you to that. The main yield curve page is worth a look at as well. That's the US Treasury bond yields. And this spread between 10-year and 1-year yield measures whether the yield curve is upward sloping or downward sloping. So if it's positive, then there's a very strong upward slope, but that happens most of the time. But sometimes, particularly here, we had a downward sloping yield curve where the 1-year yield was greater than the 10-year yield because of difficulties in financing US government debt, money market problems there. What about credit migration? That means a change in credit rating. It's also called a transition, a credit transition. Now, to review credit ratings, they look at historical data and they analyze the frequency of occurrences of credit migration. For example, they'll use the last year or the last 5 years, depending whether it's a 1-year transition matrix or a 5-year transition matrix. Suppose it's a 1-year transition matrix. So over the last year, they count the number of AA companies that changed to AAA and the number of BBB companies that changed to BB or to B or to C, and the number of CC companies that changed to A, etc., etc. They count all of those. And then they divide that by the total number of companies to get a frequency. It's not the absolute number of companies, it's the proportion of companies in their sample that migrated from one rating to another. So these are called empirical migration frequencies. And these are then used to infer over the next year the probability of a rating change of that type, or it could be over the next 5 years if they looked back 5 years historically. This is an example then of a 1-year transition matrix. Along the diagonal, you see the probability is 93.66% that a AAA rated company will remain AAA, but there's a probability of 5.83% that a AAA company will go down to AA. Or, looking at this line here for BB, there's a 6.67% chance that an arbitrary BB company will have its rating increased to BBB, but an 83.31% chance that its rating will stay the same, and a 7.47% chance that it'll go down to B. And if it's in default, there's 100% likely to remain defaulted at the end of the year. So that line is not really necessary, but these lines are. For example, the probability that a CCC rated company defaults over the next year is nearly 22%. So that's migration risk. What about credit default risk? So when a corporation becomes insolvent, in other words, it can't meet its obligation, it will enter liquidation or go into Chapter 11 bankruptcy proceedings. A credit default event occurs when a counterparty just doesn't meet its obligations, and usually there's time given, maybe it just missed the coupon because there was a temporary cash flow. Doesn't necessarily mean that it's gone completely insolvent. But if it's insolvent, it will definitely have defaulted on its obligations. So when it becomes insolvent, it's got a D rating, and as I said, legal proceedings might ensue. Now, when this happens, if the Chapter 11, or depending on the country, the bankruptcy laws are invoked, bondholders will recover some amount. It depends on their seniority. The junior bondholders might not, but the senior bondholders should get something back, not the shareholders, the equity holders. They're not going to get anything, but the bondholders should. And the proportion of the amount that they recover is called the recovery rate. So this is an analysis of recovery rates by different instrument types. This is recovery rates on loans. This is on unsecured loans. This is on senior secured bonds, senior bondholders, and this is senior unsecured bondholders. So for instance, about 70% is recovered from senior secured bank loans on average. Okay, now measuring credit risk, I'm not going to go into in a lot of detail. The risk of a credit exposure depends, of course, on its size and its maturity, and of course the default probability and the recovery rate. And also, if you've got a portfolio of credit exposures, you need to take into account how defaults and migrations are correlated, Because if you've got a portfolio of pharmaceutical bonds and one pharmaceutical company goes bust, then it's quite likely that lots of others will go bust as well. And it's the modeling, that mathematical model for correlation, which technically speaking is actually based on a copula. So it's not really correlation, unless it's a Gaussian copula. It's measuring dependency, but these are too complex for this module. It's more like graduate level material. So I won't go into detail about how this distribution of potential losses here, this distribution which typically is skewed, not normal, and you can look at the expectation is not at the mode here, it's to the right because it's skewed, but this is the losses that you expect from not just defaults, but rating migrations as well. And normally you would just provision for that in your balance sheet. So you'd have an item set aside in the balance sheet, which is provisioning for expected loss due to credit events. But then this bit here is called the unexpected loss. This is what you need to cover with extra risk capital, which we'll talk about in topic 8 only. And you'll understand what I mean by this number here. This is the value at risk here in the next lecture, not in this lecture. Go into detail. Is it the next lecture? No, it's in topic 4. In topic 4. So finally, how can we mitigate credit risks? Well, obviously with any risk, you can mitigate it by diversification, spreading investments, or in this case, it could be loans across multiple borrowers or sectors to reduce the impact of what we call systemic risk, the domino effect, when everybody defaults because one company sets another company off and so forth, and they all tumble down. The domino effect. Collateral, this is what I meant by secured loans and secured bonds. So you could secure loans with assets which the lender can seize to recover losses if the borrower defaults. And then there can be covenants. These are loan agreements which may include imposing restrictions on the borrower's behavior. For example, if the company's got a big loan, they may have to, in their company audits, the solvency ratio may have to be sufficiently high to reduce credit risk. Then you can buy something called credit insurance by entering something called a credit default swap, where lenders can purchase insurance to protect against default from their borrowers. And we'll cover these in credit derivatives and later on in this topic. Similarly, other credit derivatives like collateralized debt obligations, we will cover there. And the idea there is that if you've got like 1,000 mortgages, you tranche them to be like, the worst is the first 100 mortgages to default, then it's the second 100 and the third 100 and the fourth 100, and you would sell off these mortgage-backed security type portfolios in tranches to other people so they can take the risk and just keep the higher, the last default yourself. All right, so the next video is about interest rate swaps.